Good morning, students. So, in this presentation, we will study accounting foundations. Accounting principles, they are referred to as assumptions, uh, concepts, conventions. These are the terms which can be used interchangeably, but they have different meanings. So, in this presentation, we will cover assumptions, concepts, and conventions, which play an important role in the preparation of financial statements. So, let's begin with our fundamental assumptions. The financial statements are prepared based on certain assumptions, which are neither disclosed nor required to be disclosed. That's why they are called fundamental accounting assumptions. These assumptions have been stated by Institute of Chartered Accountants of India, ICAI, and International Accounting Standards Board, IASB. So they have stated three fundamental accounting assumptions, which we will cover in this presentation. So the basic purpose of accounting assumptions underlying the preparation of financial statements is not to disclose above facts. They are assumed to have been followed. If any accounting assumption is not followed, the fact should be disclosed in the financial statements. So let's begin. First assumption is going concern. Accounting assumes, students, that the business continues to exist and will exist in the future. The entity is not expected to liquidate in the next 12 months. So, the enterprise is normally viewed as a going concern, that is, continuing its operations for indefinite period of time. Enterprise neither has the intention nor the necessity of liquidation, liquidating the enterprise. So the assets, this is because of this going concern assumption, the assets of business are shown at book value and not at current realizable value. And liabilities are shown at the value which business actually owes and not the value which would be paid in the event of its liquidation. So, consistency assumption, this states that though there are various methods in accounts which can be used, but once a particular method of calculation has been decided, the enterprise should follow the same method. Accrual assumption, it states that the effects of transactions and other events are recognized as soon as they occur. They are recorded in the period to which they relate. Moving towards our core accounting principles. Core accounting principles, they are generally and widely accepted. These are the foundations of accounting. Like first is business entity concept. This concept considers that entity is distinct from its owners. It is because of this business entity concept only that the capital contributed by the owner is shown as a liability in the balance sheet of the business. So it is treated differently. And money measurement concept, it states that only those transactions and events can be recorded which can be measured in terms of money. Though money does not provide a stable measurement basis because it gets influenced by inflation, deflation in the economy, but only those transactions which have monetary value, they are recorded in accounting. Like for example, if we say that employee is efficient, the skills, honesty of the manager, employer-employee relations, right, they are not recorded in the books of accounts. That is, qualitative information gets ignored. So these are the entity and monetary concepts. Moving towards the next concept, that is recognition and matching. Revenue recognition concept, it emphasizes that revenue should be recorded only when it is realized. It follows, the convention of conservatism. Conservatism convention that states that, anticipate no profits and provide for all losses. So profits should be considered only when the same have been realized. No anticipated profit should be taken credit of. Matching concept, it further emphasizes that the earnings and expenses which are shown in an income statement, that is profit and loss account, they must refer to the same goods transferred or services rendered during the accounting period. So this concept requires that expenses should be matched to the revenue of the appropriate accounting period. Right? Next is dual aspect concept. It is dual aspect concept. It is very important. It states that for every debit there is a credit. Every transaction should have two-sided effects to the extent of the same amount. And because of this concept only, this accounting equation, that is assets is equal to liabilities plus equity, has come into an existence. And liabilities indicates outsiders equity, and equity itself indicates owners equity. Equity emphasizes the claim against the assets. So it is the basis of double entry system, you can say that. And if both the sides of the equation are equal, it indicates that your books of accounts are accurate. So this dual aspect concept, it in nutshell we can say that it emphasizes that transaction has a dual impact on the accounting records. Moving towards the conventions. Before we start with the conventions, let's understand what does the convention mean. Convention are based on customs. They are based on practicability. Like we do write to and by on the debit and credit side of the account. Account could be persons, properties, or expenses. So this is the convention which is followed in India, followed in UK and various other countries. So convention means an established usage, custom which has been followed in a country. So these conventions are very much important to understand. Let's begin with the first convention, that is the prudence. Prudence or conservatism. It emphasizes, as I mentioned earlier, that provide for all losses but anticipate no profits. If you want to play safe, so if the market price, for example, of stock is more than the cost, then the stock is recorded at cost, as the unrealized profit from the increase in market price is ignored. So this prudence principle emphasizes that profits are not anticipated but losses are recognized. This is again very important, because it is due to this conservatism we provide for all losses, like maintain provision for doubtful debts and all that. Moving towards the materiality and disclosure and objectivity. Materiality, this emphasizes that all the material items, all the material details must be given due consideration, whereas trivial items should be ignored, because otherwise accounting information shall be overburdened with minute details. Full disclosure, it emphasizes that accounting information that is contained in financial statements, they must disclose all the material, relevant and reliable information that is useful, beneficial to the stakeholders, that is shareholders, creditors and bankers. So financial statements, they should act as means of conveying and not concealing. And moving towards the objectivity. Objectivity, it emphasizes that accounting information and financial reporting should be independent. It should be supported with unbiased evidence. That means that accounting information must be based on research, must be based on facts, and it should not contain an opinion of the person who's preparing the financial statements. Various source documents like invoices, cash memos, pay slips, that must be used as evidence for recording business transactions. The main objective of this objectivity principle is to make financial statements more relevant and more reliable. That is information that is contained, which is contained in financial statements, that must be based on research and facts. So it will make the financial statements accurate, and it can be used to predict future company performance. Otherwise, it would be very difficult to estimate, to make predictions regarding this. So because if we are able to make financial statements relevant, reliable, then the objectivity convention makes the financial information more usable for investors, creditors and various other stakeholders who are interested in the company's performance. So let's discuss the framework which we have just discussed. We have discussed assumptions, which are the fundamental axioms for recording transactions: accrual, going concern, consistency, fundamental accounting assumptions; principles, which provide rules for the preparation of financial statements: revenue recognition, matching, cost; conventions, which are the customs followed to ensure uniformity, reliability of the financial statements; conservatism, materiality and disclosure. So if you face any doubts, kindly drop your question in the comment box and I'll definitely answer your queries. Thank you. Good morning, students. Today we will discuss accounting foundations, which is a very important topic. And in accounting foundations, we will cover assumptions, principles and conventions. Though these terms can be used interchangeably, but they have different meanings. So we will discuss assumptions, principles, and conventions in this PPT. They are referred to as, like, they are known by different names, but they play an important role in the preparation of financial statements. First, we will discuss fundamental accounting assumptions. These are the financial statements. These are prepared based on certain assumptions, which are neither disclosed nor required to be disclosed, because they are understood. So that's why they are called fundamental accounting assumptions.